Yeah, yesterday, so CBA interim result. Look, I'll just touch on some of the result highlights and then my thoughts on the investment view going forward. So, look, I suppose what I look at first and foremost with the banks in terms of their operating performance is what I call the pre-provision operating profit. So it's the closest thing to EBITDA for a standard industrial company. That was up 18% for CBA yesterday. So a very good result. The biggest driver there was NIM expansion, the 22 basis point increase. But at the EPS line, we only saw a 7% growth in cash earnings. And that's because of that normalisation of that credit impairment charge that I've been talking about. So, excuse me. So you might recall that during COVID, the banks booked a big expense to build up their provisions on their balance sheet for COVID. COVID came along. There wasn't such a big deal about that. So they released some of those provisions back through their earnings. It boosted up their earnings. Now we're coming out of that period, going back to a more normalised credit impairment expensing cycle. And there was a big headwind coming through on that front. ROE, look at 14%. To me, that is well above their cost of equity. So it means as they grow, they are creating shareholder value. So big tick there. Cash returns, certainly crank those up for investors. The dividend was up 20% versus the first half of last year. That's on the back of both earnings growth and an increase in their dividend payout. And also of particular interest, they have lifted the buyback. The current buyback program, on-market buyback program, is $2 billion. They've added an extra $1 billion out of that. Also, what you expect with CBA, they ticked all the boxes in terms of leading net promoter scores, main financial institution ratings, digital leadership, etc. So with all that sort of good delivery, why did the share price come off 6% yesterday? Obviously, it was sort of around about all-time highs before that occurred. Look, I put my finger on sort of two or three things, I suppose you could say. So first up yesterday, the federal government directed the ACCC to investigate how the banks pass through higher cash rates into deposit rates. I don't think that will come to much, and certainly if we want to get into a chat on that, I can walk you through it. Secondly, the RBA commentary yesterday talking about high rates of inflation, the strength of the domestic economy, and needing more rate rises. Look, I suppose that points to more of a potential hard landing than soft landing, so certainly not something that the banks want. But third, and I think probably foremost when it comes to the bank's narrative, it was the NIM. Now, I talked about how the NIM had expanded, big tick, but we had been expecting further NIM expansion to come through as the lagged impact of rate rises comes through and as the RBA increases rate rises further. But what CBA showed yesterday was that their NIM actually peaked in last October and has stabilised, if not actually trended downwards a little bit. So that is a big change to the narrative. And what do they highlight there? Well, they basically said, yes, we're getting the benefit of the higher rates coming through on our low rate deposits. We're getting the leverage there, but we're getting higher funding costs coming through. And also there's just this intense competition. I mean, we all know about these cash back offers that are getting thrown around. CBA having to play in that market. Management commentary also was very cautious about the impact of rate rises and higher cost of living on their borrowers. When you sort of think about that, that comes through in terms of their own cost base through potential credit growth. So I've got credit growth actually slowing through into FY24. Asset quality, savings rates, and they also pointed that they're expecting consumer discretionary spending to come off in coming sort of 3 to 6 months. What have I done with my forecasts? Well, short-term forecast changes are relatively immaterial. Using a new macro deck, so it does actually help out the longer-term forecast a bit. Target price has actually lifted up 3% to $96, so still above where my valuation is, where the stock's trading. Look, the stock obviously fell quite a lot yesterday, but when I look at it versus my DCF, and also I've got within my pack there where you can have a look at historical trading ranges for key multiples. I apply those then to my forecast numbers for those particular multiples. So for example, for the PE, look at historical trading range and then apply that to my forecast EPS to come up with a valuation range based on PE. You'll see that the stock's trading right at the top end of those ranges. So to me, not particularly cheap, certainly a stretch sort of fair value on those sort of fundamental valuation ranges. If you look at it on a yield basis, it's trading, and let's call it a sort of cash yield of around about 4%. So that's looking quite compressed now versus where deposit rates are. You're getting deposit rates of sort of 4% or so. So certainly not particularly attractive for an income-orientated investor. And look, to me, I suppose the worry here, and I suppose it's reflected in my valuation, is the downside risk is if this is where we're at peak earnings at the moment, and the narrative changes from focusing on the upside to do with the NIM expansion to now to do with more the inflation coming through the cost base, the risk to the asset quality, slowing credit growth, etc. So, look, kept a hold on it. It's still obviously very much a core major bank portfolio holding for long-term portfolios, but certainly I think maybe the short-term investment performance may be a bit more limited to this one. So, if you've got very overweight positions, you certainly may want to consider trimming on that front.